Hello, everyone. It is Tuesday, March 7th. We're a few days behind, but we are going to deliver our market and economic update for February. So let's jump into it. We're going to start here with a couple of charts that were delivered to me by Fundstrat, a research partner of ours. And they did some research on kind of what happens in the beginning of the year and how that kind of unfolds for the rest of the year. So this data is going to go back to 1950. And on the top, you can see we're going to look at when the first 5 trading days of the year are positive by 1.4% or more. Okay, so if we get off to a good start, what happens next? And you can see in this data that February, which is highlighted with the red box, is pretty negative, right? And as to be expected, as they put in their notes, kind of a payback, right? You got a good January, we're going to get some of that back, then we can trudge on. So what's interesting is the win ratio, or the amount of times February is positive, is only 57% of the time. Okay, and for a median return of only 0.2%. So February week, when this sort of hot start to the year comes our way. Let's jump to what happens now in March and April. Okay, look at that red box in March, a 100% win rate. So whenever the first 5 trading days of the year are 1.4% or positive on the S&P 500, then March is positive 100% of the time, which is wild. And the average rate of return in March is 2.6. Now, April also very strong, 86% win rate for an average rate of return of 4%. So what we wanted to highlight in this is that in the historical data, what we've seen so far this year is on par with averages and, to be expected, right? Every year is different. Every circumstance is different. Today, Chairman Powell in his testimony kind of rattled the markets a little bit with the higher for longer on interest rate talk. So maybe this year doesn't, the trend gets bucked. That could definitely happen. But for right now, the trend is in play. The other thing I want to show you here is trying to really just hammer down on our long-term expectations. And this graph shows when over the last 52 weeks, when there were how many times each week there were more bulls than bears. Okay, so out of 52, how many times were people more bullish than they were bearish? Okay, and you can see in that little circle all the way on the far right of the chart at the bottom, over the last 52 weeks, there were only 3 weeks out of 52 that there were more bulls than bears. Now you can see this is lower than the great financial crisis. It's lower than the dot-com bubble. The point is today the average investor is unbelievably bearish, right? Meaning we're negative, the market's going down. Now you can look, if you look closely, in those periods of time, if you held on, if you stayed disciplined to your long-term investment strategy, you were drastically rewarded with really good returns. 128% after COVID, 124% after the great financial crisis, 71% after the dot-com bubble. So we are in another one of those moments, right? Don't believe the this time is different camp, okay? There's nothing that's showing that this time is going to be different. It's going to be unique, but the end result will most likely not be different. So stay with your long-term investment plan. Let's take a quick look at particular charts on the S&P 500. Whoops. So this is the S&P 500 since the beginning of the market starting to fall at the peak there in the top left. That purple line is the 200-day moving average, often seen as a long-term barometer of the stock market. If it's sloping up, bull market, sloping down, bear market. Okay, so we've obviously been sloping down for the better part of the last, call it 14, 15 months. Now, what's interesting is this has been a point of support and resistance, okay? Take a look at that first red dot. After we fell below, we kind of rallied back to it. The 200-day, right when we got to that price, we got kicked off. Again, back in August, we rallied up to the 200-day, fell back down. Again, rallied up to the 200-day, fell back down, and then once more. Now you can see we got above this here in January. Okay, February starts to pull back down towards that purple line, towards the 200-day moving average, except for this time, the 200-day moving average was support. And there were more buyers this time than sellers, and it has pushed the market back higher. Now, today, as you can see from that dark line on the far right, kind of a negative day in the market. But holding this 200-day moving average is going to be critically important to, be able to say we're in the bear camp and that we believe markets are going to progress higher. Falling below that line is going to be, a very bearish signal to the market that we're going to have to pay attention to. The other thing on the S&P 500 that we're paying a lot of attention to is momentum. So I've shared this a few times in my updates, but relative strength is in this bottom panel here. And how relative strength works, it's 0 to 100 momentum indicator. Okay, so 60 and above, think good, think bullish, right? If it gets to 70, that's considered overbought or a drastic shift in momentum. And on the flip side, under 40, bearish, negative. If it hits 30, very bearish and negative, often referred to as oversold. Okay, the main thing I want to show is in that box, really when this downturn started to come, we spent a lot of time 40 and below, right? In that bearish camp. You can see how many times we were wiggling in there and we're falling into that territory. Now what's happening, right? Over these last, call it 6 months almost, right? The market started to recover, but the momentum is starting to recover as well, spending zero time in that 40 or below, okay? Now we've gotten into the 60s. We haven't hit that 70 to really send us for a bullish momentum indicator, but we are spending a lot less time and virtually no time below that 40. So that is a very good sign. So again, some constructive things have happened in the beginning of the year. We do expect it to continue to be choppy. The news from the Fed and interest rates and inflation is going to move this market throughout the entire year. But for right now, based on those technicals, we would still put ourselves in the bullish camp for the time being, but subject to change as that data change. So as always, give us a call if you have any particular questions. We hope you have a great rest of your week. We'll talk to y'all soon.